If you want to become a successful trader, there's something you need to understand. Risk management is not a set it and forget it kind of thing. It's something you should always keep top of mind. No matter what strategies you use, how much experience you have, or what market conditions are like, risk management should always come first. In this video, I'll show you some new ways to implement risk management in your day-to-day trading to improve your overall performance. But before we get into that, make sure to hit that subscribe button so you never miss out on any of my future content. And if you find this video helpful, please give it a thumbs up. In the world of trading, we often hear about the importance of risk management, yet many traders don't fully grasp its significance until they face losses. Most traders know that each time they enter a trade, their maximum loss is limited to their stop loss. However, they fail to realize that each trade also has a maximum gain. Consider this. If your target is a 10-point profit, but you only have a 2-point stop loss, your risk to reward ratio is 5. This means that for every dollar you stand to gain, you're risking $5. If your risk to reward ratio is poor, it doesn't matter how skilled you are at entering trades, you won't be profitable. So let's talk about a way to always have a good risk to reward ratio. First things first, open up your favorite charting software and select your preferred currency pair. Then zoom out to the 4-hour time frame. Why the 4-hour time frame? Well, it's a good middle ground between being too granular and too broad. At this level, you should see a few supply and demand zones. Mark them up. How do you determine supply and demand zones? Simple. Look for candles with high downward momentum towards a particular price level. That's your demand zone. And when price falls sharply from a certain point, mark that as your supply zone. Supply zones are where price tends to sell off. So if you see a demand zone being broken through, it might be an opportunity to go long. Similarly, if a supply zone is broken, consider going short. The key to success is not jumping into trade right away. In fact, that's the biggest mistake most traders make. Instead, refine your zones to pinpoint the best entry spot. To refine, simply switch to a lower time frame. For instance, if you're on the 4-hour chart, go to the 1-hour chart. Find the exact point where price breaks the zone you marked on the 4-hour chart and draw another rectangle around that area. Essentially, you're zooming in to find the precise moment to enter a trade. Let me clarify something. The zone on the 4-hour chart represents the area where price made a significant move. Your refined zone on the 1-hour chart indicates the exact point within that area where price changed direction. Now you might be thinking, wait a minute, wouldn't it be better to refine further to get an even more precise entry? Well, yes, but there's a catch. You need to follow what I call the 2 steps down rule. Here's how it works. Let's say you start on a daily chart, refine once to the 4-hour chart and again to the 1-hour chart. From there, go to the 30-minute chart, refining twice more to the 15-minute and 5-minute charts. You can continue refining, but it's not necessary. The idea behind this rule is that each time you refine, you're getting closer to the actual moment of a price change. Zooming in too far won't improve your entry, and you might end up making mistakes because price might not reach those extremely fine levels. Think of it this way. You wouldn't use a sniper rifle to shoot a target that's 100 meters away. You'd use a high-powered scope on a regular rifle. Refining your zones too much is like using a sniper rifle for a close-range shot. You've got the wrong tool for the job. Remember, the goal is to get a clear picture of price movements and enter trades based on that. Over-refining can actually make things more complicated than they need to be. Let's look at a real-world example. We're using the GBP-USD pair on the 4-hour chart. We've marked our initial demand and supply zones. Now let's switch to the 1-hour chart and find the exact points where these zones were broken. We'll do the same for the other marked zones. By following the 2 steps down rule, we've successfully refined our initial zones. Now you might be wondering why we went down to the 1-hour chart instead of, say, the 30-minute chart. Well, the 1-hour chart gives us a good balance between detail and clarity. If we had gone straight to the 30-minute chart, the lines might not have been as obvious. Using the 1-hour chart gave us enough detail to see the breakouts while still providing a clear picture of the larger trend. But some of you might be asking, what happens if price keeps moving in the same direction after the breakout? Should we keep refining? The answer is no. When price continues moving in the same direction, it's a sign that the previous trend is gaining momentum and the market is likely in a strong up or down trend. In this case, it's best not to force a trade. Patience is key. Wait for the next demand or supply zone and refine it following the 2 steps down rule. You might be thinking, hey, this sounds like a lot of work. Is it really worth it? Well, absolutely. Just think about it. If you're entering a trade with a 1-to-2 risk to reward ratio and you could double that to 1-to-4, wouldn't it be worth the extra effort? What if you could make it even better, say 1 to 11? That's exactly what this method allows you to do. Let's illustrate with a concrete example. Let's say you're looking at the AUD-USD pair on the 4-hour chart. You've identified a demand zone that you want to refine. Switch to the 1-hour chart, find the exact breakout point, and draw your refine zone. Now let's pretend you're using a simple moving average as your dynamic support and resistance. The ideal position for your stop loss would be below the zone. If the distance between your entry and the stop loss is 20 pips, then your risk to reward ratio would be 1 to 2.1. That's pretty standard and nothing to write home about. However, if you were to refine your entry to the 30-minute chart, finding the precise breakout point, your stop loss would still be at the same level. But now you've increased your potential profit by 3 pips. Voila, your risk to reward ratio has doubled to 1 to 4.1. But the magic doesn't stop there. If you were to refine again to the 15-minute chart, bringing your entry closer to the zone, your stop loss would remain at 20 pips, but your potential profit would rise by an additional pip. This brings your risk to reward ratio up to 1 to 5.1. And if you were to refine to the 5-minute chart, your risk to reward ratio would jump to an impressive 1 to 11. All because you took the time to find the perfect entry point. As you can see, this strategy can make a huge difference in your trading. The secret is to refine your zones properly, following the 2 steps down rule and taking advantage of strong trends. Don't just dive into trade blindly. Take your time, analyze the market, and make informed decisions. And that's it. With a little practice and patience, you'll be well on your way to becoming a more successful trader. Thank you for watching, and remember, the best way to improve is by doing. So go out there and put what you've learned into practice. And if you enjoyed this video, please give it a thumbs up and subscribe. Until next time.